Hello and welcome to Meliesron Ltd's investor call regarding the financial statements for the fourth quarter of 2025. Please note that all participants in the call are in listen-only mode. During the call, you may send questions via the chat. Please state your name and your company's name before your question. After the company's presentation review, questions will be addressed. For your convenience, this meeting is being recorded. The recording will later be uploaded to the company's website. Joining us today are Mr. Ofer Sarid, the company's CEO, and Mr. Oren Hillinger, the company's CFO. Before I hand over the floor to Mr. Sarid, I would like to clarify. This conversation does not serve as a substitute for reviewing the company's reports published on Magna. The information provided here does not go beyond what is included in the company's public reports. I direct all participants to carefully read the company's reports, which contain the complete disclosures in accordance with the securities law. This conversation does not constitute a recommendation to buy or sell the company's securities. In this talk, we will also refer to the company's business targets and plans regarding the future development of its business. It should be clarified that future targets and plans constitute forward-looking information as defined in the securities law, which by its nature is uncertain and may not materialize or may materialize differently from the company's plans. In the event that an alarm is sounded, we will pause the conversation and resume it after about 10 minutes. The floor is now given to Mr. Sarid, please.
Thank you very much, everyone. I am glad you joined our conference call. We are marking a very good year. In a moment, we will get into the data, and I will also provide information about what is happening today, what things look like now after we reopened, after we were closed due to the war and reopened about 2 weeks ago. So we will talk about all this data. There are a lot of interesting things, so stay focused. I hope you slept well last night. All right, regarding Meliesron, for anyone who isn't very familiar with our development from this conversation, I'll just emphasize 2 things here. First, we already manage over 1 million square meters of properties. Most of them are malls, offices, and various other things. Over the past year and a half, our controlling shareholder, Liora, has increased her stake, and she now holds about 51%, while the rest of the public holds about 49%. In terms of our activities, they are divided into 3 main areas: malls, offices, and logistics centers. I'll elaborate on each of these activities in general in just a moment. In malls, we manage over 500,000 square meters, and the value of the mall assets is approaching 20 billion in asset value. And occupancy rates have been very, very high for many years. We see this, it's almost constant. Regarding the offices, occupancy rates are also extremely high, even during recent years, which have not been easy, actually quite challenging in the office sector. So there too, we're seeing very strong occupancy, and that's due to the nature of our assets, which I'll elaborate on later. Here as well, the asset value is already nearly 10 billion shekels, and we have very significant business development in several segments, some of which we've already mentioned, and I'll detail them further later on. The residential activity is our 3rd area of operation, a very strong and extensive activity. Today, we hold a portfolio of a great many urban renewal deals plus land. In total, we have a pipeline of about 12,000 units altogether, of which 6,400 are already in planning and execution. We'll elaborate on this later because we've started construction on many projects and marketing on many projects. We'll also talk about what's happening in the residential sector overall, especially considering everything that's happened here in the past year or even the last couple of hours. Let's start with our asset map. Most of our NOI comes from regional malls. They have a lot to offer. They are undergoing significant changes with a very precise and appropriate mix, large parking areas, cinemas, restaurants, cafes, and so on. In short, the regional malls are very large. They do the job, and they generate 50% of our NOI. After that, 1/4 of the NOI comes from office and high-tech parks. Part of it is in Tel Aviv, part in Yokneam and in Tirat Carmel, also a bit in Ra'anana, and a lot in Petah Tikva. The power centers are performing excellently, making up almost 10%, and the neighborhood and urban centers make up the rest. When we get to the topic of the war, I will elaborate on each of these points and explain how it works. how it worked in 25 and how it works today. Besides that, an asset, or in my view, a very significant asset, is the investment in Aviv. It doesn't appear as an asset we bought or as some office building or another mall. Here, we acquired a new operation. The investment amounted to over 1.2 billion shekels, and we are putting a lot of resources into it so that this operation will grow, and you will see its growth over the past 3 years. From this, you can also infer where it is headed in the future. Regarding the malls, this is an important slide, so please focus, because I will be discussing many details here that are relevant and still relevant today. Let's start for a moment with what happened in 2025. First of all, 2025 was a year that also saw the war with Iran, the first one, let's call it, that lasted 12 days. During this period, these 12 days, the malls were closed. All right? I'm not normalizing anything here. We're presenting the revenue data, what happened in 25 compared to 24, compared to 23, without normalizing and without excluding the month of June. This includes June as it was, even though a third of it was completely closed. I don't think we need to neutralize anything. I think we should look at the data as it is. So without neutralizing anything, when I compare the revenues of the year 25 to the revenues of 24, which was a record year, we're more or less at the same level. There's a 1% decrease in revenues, including the fact that in June there were 12 days of closures. That's the first point. It also includes the fact that overall 2024 was a record year and the skies were half open, half closed. In 2025, the skies also opened and there was a 33% increase in Israelis traveling abroad. So despite a 33% increase in flights abroad in 2025, and despite the 12-day war with Iran, we're presenting the same record revenues. We maintain the record revenues of 2024. I think that's an achievement for the Israeli economy. I think that milestone reflects the macro of Israel's economy because we have malls, offices, residences, and we're spread all over the country from end to end. I think it's a badge of honor for the state of Israel for managing to maintain routine during wartime. I would also like to take a moment to point out that in the last quarter of 2025, there was already a 1% increase compared to the corresponding quarter in 2024. But plus 1%, minus 1%, it was actually quite convenient for us to observe. In 2025, we maintained the high bar set by 2024. You can also see, when comparing to 2023, exactly how that growth trajectory looks in comparison. If we skip 2024 and look at 2023, for example, in fashion and management, there's a 16% increase. That means an 8% annual growth rate, which is extremely, extremely high. Regardless of the specific way you choose to calculate it, it's a very, very high rate. Now, what's happening today? We understood 2025, and we saw that it was perfectly fine, even good in 2025 compared to previous years, despite the war and the opening of the skies and so on. So what is happening in 2026 with the ongoing war? This conflict began, as we all know, on Saturday, the 27th of February. What happened was that as soon as the war started on Saturday, they announced that the malls would be closed without saying when they would reopen, but they actually reopened them pretty quickly. They closed the malls on Monday, Tuesday, and Wednesday. And on Wednesday night, they announced that starting Thursday at noon, the market and the malls would reopen and the entire market would go back to work except for gatherings of more than 50 people, etc. You know the regulations. And basically, when we reopened, just like every time we reopen after a war or after COVID, or God forbid, after October 7th, we're already used to the business routine of what happens after a closure caused by any military situation that has occurred. What happens is that at first, only a few people come by and they buy even less. And then a few more people arrive and they also buy a bit more. And then gradually it picks up until it finally reaches its pace. If there is a very, very, very difficult period of fighting, like there was on October 7th, then until things settled down, it took 2.5 to 3 months for it to reach a relatively normal state. And you can also see in front of you the results for 2025, which were basically like those of 2024, even though the war was somewhere in June, the same thing that happened on October 7th. It took time, and then 2024 turned out to be a really, really, really good year. It takes time, and I can tell you what happened in our malls during the last 2 weeks, including this past Friday. Let's actually start with the positive side of things. Last Friday was absolutely fantastic, and it was very good in the malls. I think the first siren in the central region was at 1:30, which was already after people had arrived at the mall and finished up all of their shopping and so on. We're seeing results at a rate of 115% compared to a regular Friday. Meaning, everything I said refers to 2 weeks that were more difficult, and here Friday was significantly calmer and was great. That makes up for some of the not so great times we had before. In general, on average, it starts with entries to the malls. I'm intentionally providing a lot of data here because I think it's important, and soon you'll also ask me or want to know what we're doing about rent, tenants, and so on. And that's what I'm detailing here on this slide because it's very, very relevant. First of all, let's talk about mall entries. On average, mall entries have decreased by about 14% overall, but averages can be misleading. Never trust averages. We need to break down the average for a moment. A 14% decrease doesn't sound like much. It seems relatively reasonable given the situation we're in. But we need to break it down for a moment. Where is it higher? Where is it lower? Because in the end, the problem is where there's actually a problem, not where there isn't. So it's highly distributed and specifically segmented. So it works in the following manner. If you take a closer look at neighborhood malls, or if you take a closer look at even urban malls, or malls located, say, in the Jerusalem area or in the south, the foot traffic there is perfectly fine. In some cases, even better in the neighborhood malls, because it comes at the expense of the regional malls, as fewer people are traveling to those areas. In the regional malls, there's a decrease of about 20% on average in entries. And as I go further north, the impact is even more significant. The war there is more intense, with much shorter warnings, or sometimes no warnings at all, depending on how far north you go. We're not in the far north, but we are in the north, so there, the decrease in entries can reach up to 30%. When I look at the revenue figures, it is much the same story. In the local neighborhood malls, in the south, and in that general area, the declines are relatively smaller. In the center, it's somewhere in between, and the north could be more significantly affected in terms of the overall drop in revenues. Up until last Friday, when what I mentioned happened, what will happen next? I don't know. I can never say what will happen next. We are now in the period before Passover. I really hope this will be a time of a bit more calm, as we've seen in recent days. There's been a decrease in rocket launches and so on. We're still waking up at night, going into the shelters and so on, even during the day. We're going into the shelters, and maybe even during our conversation, we'll have a siren. It's not a big deal. People are going back to malls, back to offices, continuing to work. I estimate that the people of Israel will be in Israel for Passover. The number of flights, there are no flights, right? I don't think that even if they open up, many people will leave. The Passover Seder will not be held on Zoom. Absolutely no one is going to do the Seder on Zoom this year. So we are currently in a kind of wartime routine right now. And I truly believe that this specific wartime routine will lead people to purchase and consume goods in a way that is much more similar to how it was in the days leading up to Passover. And the more similar it is compared to previous years before Passover, of course, we will meet again and provide a full report on it. That's all regarding revenues, foot traffic, and what happened on the 24th and what's happening on the 26th. One last point. Since the situation is uncertain, the first thing we did was to make things easier for our merchants. We said we wouldn't collect payment for March and postponed the collection for March. We delayed it until we could see for a moment what was happening. And now we're really at a point where we want to know what's going on. So I've explained to you what's happening, and we're already approaching the collection for April. Our goal, working together with the merchants, is not to burden anyone. Our aim is that we know the war will end, and then maybe all the revenues will return, or maybe they'll come back a bit less, and then we'll need more help. We still don't have certainty. We still don't know how the return to normal will look. I hope it will be as quick and as good as possible, and that it will make up for the days that were really not so good. Once we know that, we'll decide exactly what to do with the merchants. At the moment, we are easing their cash flow and did not collect payment for March, and it's possible that the beginning of April will also be postponed. That's it for now, just some ideas. I hope I answered all the questions that are relevant to you. I skipped 2 slides. This one was so important that it just couldn't be skipped. Let's take a moment to talk about what's happening right now in terms of our performance. Ultimately, our results are determined by contract renewals, option renewals, and our initiatives for new spaces. So first of all, here you can see the projections at the top, 700 deals, 415, the first row, 415, 110, and so on. There are 700 deals here, so this really does reflect everything that's happening at Meliesron, and it might also indicate what we can expect to happen in the future as well. The results in 2025, as you can see, were excellent. Even in contract renewals and exercising options, we increased the rent by 5%. When a tenant finishes and renews a contract or a new tenant comes in, then the rent already goes up by 24%. And you can see the area, it's 17,000 square meters, okay? First of all, in proportion to the area as well, when you analyze these increases, also compare them to the second row. And in offices, the results are surprisingly positive. We have a 3% increase, and in new contracts, an increase of about 11%. Now, I'll talk about this in a moment. There's a slide for offices, but some pretty good things are happening there. Stay with us and we'll talk about it. All in all, if I sum up everything that happened in terms of contract renewals, options, and new contracts, we're talking about an increase of around 8%. That's a real increase of 8%. And on top of that, add the index. Beyond that, in the lower part of the table, you can see the impact of our new development. Areas that didn't exist before, like Yavne, Nof Hagalil, and so on, for which we've signed contracts. You can see that they will bring us, on an annual basis, about 70 million shekels, which is the 46 plus 24 you see at the bottom. Besides that, we'll talk more about the development later on, in terms of let's go back. Let's move forward. This is a new slide that, we decided to include, and I think it's an important one. You can see a lot of data here. Again, I believe that Meliesron's reports are, I'm proud to say, the most transparent, open, and detailed there are. And as part of our transparency and detail for our investors, and that's you, it's very important to us that you also know how to analyze the company in both good times and less favorable times, and to analyze its assets. So we've listed the main assets here, and we've also included what was in 2022, so that we can compare 2025 to 2022. We've also included the representative figure. The representative means, according to the current contracts, what the NOI should be, because the 2025 figure is derived from contracts that were active in January, and maybe things changed during June or in December. The representative figure reflects where we stand today, and this is also what affects the value of the assets on a weekly basis. If we look at Ramat Aviv as a primary example, you can see that it has shown strong growth from 2022 to 2025, increasing about 23% in NOI. But that is not the final word. 185 in 2025 ultimately translates into moves we have already made, which exist now and will yield results going forward, to a much higher representative NOI of 202. In general, regarding Ramat Aviv, let me address Ramat Aviv for a moment. There is new competition, as we've discussed in recent quarters and so on. We've made a lot of moves, though we haven't completed all of them yet. But overall, these steps, such as moving the food court up to the 3rd floor, the completion of the 3rd floor, which will soon open, by Passover, the 3rd floor will already be open, which is just 2 weeks from now, plus the changes we've made to the tenant mix, which I've detailed in previous times, and in addition, more luxury stores, including one very, very large one that is also set to open in April. We've taken steps that truly differentiate Ramat Aviv Mall as the ultimate in luxury. And we're not just trying to blend in with anything else. It's a unique mall, and we're making sure to keep it very, very special. As you can see, the steps we've taken are already bringing in 202 million shekels in NOI, and of course, this has impacted the increase in value, which now stands at about 3.2 billion shekels. I want to address a few more points. Regarding the Kiryat, which we have discussed for years, we have taken strategic steps to move forward. You can see the results right before your eyes. NOI has grown from 150 to 186 million shekels, with a current run rate of 210 million. The Kiryat's value has now crossed the 3 billion shekel mark, and you still haven't heard the last word. It is truly endless. I don't know how many people actually visit the Kiryat, but I'm sure some of you are from the north, and if any of you from the north haven't been to the Kiryat for half a year and come today, you wouldn't recognize it. Things are changing, renovations and so on. I don't have the time right now to go into detail and talk about them. I won't elaborate on the other two malls, just take a look at Hutso Hamifrats and Bilu Center. The camera is making it hard for me to see this, but Hutzot Hamifrats, we're going up from 60 million to 100 million shekels, and the youth, and look at what happened to the value. The value has already reached 1 billion. The same goes for Bilu. We are putting in the work at each of our complexes, at each of our malls, and this has led to strong NOI, and I'll explain in a moment what strong NOI means, but it has also led to an increase in NOI and in the value of the malls. What is strong NOI? There are times when the changes we make do not necessarily increase the NOI. They can even lower it slightly. When it comes to rent and contracts, it could even be that a new contract is a bit less favorable than the previous one, but the previous contract had weak NOI and the new contract has strong NOI. So what does strong mean? It means that the tenant size is not too big, not too small. They're in the right location where they should be, and the person there fits our tenant mix, okay? And also their burden in terms of the rent to revenue ratio is suitable for them and for us. That is, there is a balance between all four of these components. That's a strong NOI, that's a sustainable NOI, one that will stay with us for many years to come. And it also serves the mall as a shared space. If it's strong, that tenant or that change we've made has a positive impact on everyone around them. Let's continue. In terms of projects under construction, both Yale and Nof HaGalil are progressing with very, very impressive development. With Nof HaGalil, we might even slightly extend the timeline, but in any case, the schedule we've set, we will meet it, and that's truly fantastic. And it's going to change everything completely, meaning it's not that we just added another extension, and this extension is as big as what existed until now. In other words, we doubled the area, but as I said, this is an area of it's a mall, it's a shared building. This addition, along with the modifications we're making to the existing structure and the renovations we're doing to what's already there, and the new mix that can bring a place like this to over 40,000 square meters, that's something completely different. It's not just the same thing as before, simply doubled. Maybe a doubling would add another 50 or 80%, but here, the scale of the addition is much greater, both in terms of NOI and the strength of the complex. It will be a completely different and more impressive complex. Yavne is going very well. Here too, we are progressing according to schedule, and from the merchant's perspective, it also looks promising. Offices, we are currently managing almost 500,000 square meters out of the little over 1 million that we have. As we mentioned, in general, we maintain very high occupancy rates, and today our representative N-wire is already almost 440 million shekels according to the latest data. These 400 that you see, it's not even halfway. With our new balance, we're already reaching 600, surpassing 600, up to 610, 620 million shekels in NRI. We are developing very, very nicely in offices because we have prime locations and very high quality assets. Regarding future development, I mean all our projects totaling over 100,000 square meters. This is strong development, and I'll explain what that means. Just as the NRI is strong, I'll explain what strong development means. Strong development means that it is not speculative. Here we even have agreements and even signed agreements for most of the area and with the best retailers in the world, you could say. And I'm not exaggerating. I usually don't exaggerate, but in this case, these really are the best in the world. Let's talk for a moment about Landmark B. We also announced this last week. Landmark B is 45,000 square meters, and we've leased all of it from 0 to 100. We worked on this for a long time. But this is from 0 to 100. It's not in stages. It's leased from 0. As you saw in previous reports and in the upcoming reports, you'll see it's 100% leased because everything is signed. What does it mean that everything is signed? Waze from Google, in other words, the acquisition by Google has been completed, is taking the upper half of Building B, and a group of other companies, of course in the high-tech sector, are taking the lower half plus all the commercial space, plus, in short, it's fantastic. Really, it's a badge of honor. I don't want to exaggerate, but it's also a badge of honor for the state of Israel that such very large international companies are here. They are investing, entering, and developing in the center of Tel Aviv, and this is happening during a time of war. So yes, this is during a time of war. The agreement was signed and everything just a few days ago, and it's finalized. Beyond that, in Yokneam, we signed with the building we called the Air Building, because in each of our properties, we want to have a kind of battery/inventory of institutional tenants and start filling them up. Well, this inventory was gone in an instant because NVIDIA took it. NVIDIA, who is a major tenant of ours in Yokneam, took another building of 29,000 square meters, and it is fully leased. We have now started, not just starting, we've already begun its construction, and we hope to finish it on time, which is roughly about 2 years. And then we basically hand it over to NVIDIA, and NVIDIA will continue with it, along with its other properties with us. So Yokneam is currently at 100% occupancy, and it's performing exceptionally well. Also at Ofer HaKarmela, it is at a very, very high occupancy, and we have another building for which we are now in the permitting process. We need to obtain all the necessary permits and start working on it. That will happen in 2026. Lincoln, which you see in the picture, that strikingly beautiful brown structure. It's not just brown paint, it will actually be bamboo, because we need to do things that are interesting and architectural and so on. It's in a truly fantastic location, right on 2 light rail lines. It's a great project, we really believe in it, and we are commencing construction during the current year and will finish it in about 4 years. The expected NOI from these projects is 174 million shekels, and as I explained earlier, we know that we will surpass 600 as a result. In other words, we have strong development in the office sector, which is certainly no easy task, but as you can see, things are closed and signed, or in places where we feel that they are really, really, really good. We also said they were really good a year ago, and here's the proof. Even the ones we called really, really good, there are contracts that are less good. Let's move on to residential. Regarding residential, there have been there are a lot of articles about residential in the past year, and some of them were also about Aviv and so on. So I'll focus for a moment on us, on Aviv, what we're doing at Aviv and what we intend to do in the future. This is the growth in the parameters of Aviv Melisaron company over the past 3 years, okay? From the time we entered and acquired the 50% until we finish now, as of December 31st at Aviv, you can see that in all the operational parameters, we are experiencing very, very, very significant growth. We have understood the company, expanded everything that needed to be expanded, and implemented all the necessary methodologies over the past year, and we are continuing to do so. We're not done yet. We still need to do a few more important things at Aviv in the coming year to support this incredible growth. And it really is truly remarkable, crazy growth. If just a year ago, Aviv was developing 100 housing units in one single project, today we have already expanded our operations over, I'll show this to you in just a moment, spread out over 6 different projects, with another 6 projects about to begin and get underway. We are already spread out over many projects with thousands of housing units under construction and more in planning that will soon move into execution. Even units that are still in the planning stage require a lot of G&A, require a lot of capabilities within the company, and these capabilities have been understood. Look at the number of our projects. We've grown, more than doubled. Our apartments have also more than doubled. The gross profit has more than doubled as well, and also the number of units with the required majority. This means that we have over 67% signatures in urban renewal, also on Pellet Plus. So we have a great number of ambitious goals at Aviv Melisaron, and I really hope that we will also successfully achieve them in the near future. If we take a moment to look at the data on expected units for sale, we are almost at 4,000 units, most of which are urban renewal, and we still see a lot also in the lands we have purchased, whether it's Esdedov, Shchakim, Shirat Hayam also in Tel Aviv, in Tabankim, and the expected units for construction, because we are building more than we are selling since we need to provide apartments to the owners who were part of the urban renewal. So we The company also need to build 6,400 housing units, and on the left side you can see that by the end of the year we should be in the process of constructing 2,300 units. Do you agree? We were at 100 in the year 2014, early 2015, going from 100 to 2,300. You can also see the continued growth, and if I look at the gross profit margins, they are also very, very, very high, and we hope that we will maintain those percentages. For now, these are the results we are proud of, with an expected operating profit of almost 3 billion shekels, and also expected revenues of about 19.5 billion shekels. So there is very, very strong progress. Aviv, the projects you see at the top, the 5 projects at the top are already underway. As I said, the projects at the bottom, some are already being marketed, and some will enter the marketing phase during the coming year. Shchakim will also enter marketing, Tabankin will enter marketing, and Yayav will also enter marketing. So we will have about 8 projects in marketing and execution during the year. Right now we have 5 in execution, and Yayav will also enter execution, as well as Hey and Dalet, and Shirat Hayam will enter execution. We will be in the execution phase of projects. There is a very, very large company for this. This is an important slide. You are analysts who analyze financial reports, you analyze many residential companies, and you understand that the financial reports of residential companies are very similar. We won't give an accounting lesson now on why they don't reflect the reality of a residential company, but I suggest that you take the opportunity to talk to Oren, Roy, or Tal and understand for a moment the main points, because if you replicate what we do, you'll simply replicate it elsewhere as well. Take a moment to understand the gap between financial reports and what a company's actual performance really is. Let's call it that for now. So earlier I included a few slides about performance and progress in work plans, but I think this slide is also important. What does this slide say? This slide says, you know that revenue recognition in residential real estate basically means saying how much I sold multiplied by how much I've executed. That is, if I only sold but haven't yet started construction, then revenue recognition is 0, but I did make the sale. Let's assume we sold the entire project. There were 100 apartments in the project, and we sold them at fantastic prices. There's no revenue recognition if I haven't started yet. When I start, I first put up a fence, which is maybe 1% of the project, and after that, just some work and so on and so forth. The more you build, the more you can recognize that income, that same 100% of the income, until the construction is completed. Suddenly, after 3 years, 4 years, 5 years, it depends on the size of the project, they actually recognize all the revenue from what we sold, let's say, already today in this example. What the slide shows you is that we made sales, we executed sales, all the projects that we started to execute and started to market, we've already reached the 25% threshold, we're already under bank supervision, we're already in execution, so we're not worried about the projects. And the continuation of sales, since I'm already under bank rating, now it's about the pace of execution, and the pace of execution is for very, very large projects. Some of them will even take 5 years, so there's no particular pressure here. But for the projects we've sold, we haven't yet recorded revenues for 1.24 billion. That's what you see here on the right side. Meaning we've sold, there's a deal, but I haven't yet recognized it as revenue, not profit. I haven't recognized it as revenue yet. When will I recognize this revenue? When we start building. Let's assume I have total projected revenue here of 1 billion Israeli shekels, and I haven't even started building yet. When I finish building, I'll be able to recognize the entire billion. That means in order to recognize an additional 1 billion shekels in revenue, all the company needs to do is simply build. So we are making progress on the projects. You saw them under construction, and anyone who wants can also come and coordinate with us, and we'll do actual site visits as well. The construction, as it happens, not just as it happens, but as it progresses, and you can be sure it is happening, as it advances, we will recognize the 1 billion shekels. Construction is an essential business. We are working. When the war started, there was a bit of chaos for a few days with cranes and municipalities and such, but within a few days, these things were sorted out, both with the municipalities, the cranes, the workers, and so on. We are at work. At this point, I'm going to hand over the financial results to Oren for his presentation, and then we will continue after that with a few more slides to conclude. Thank you very much for your time.
Ofer, and good morning to everyone. This morning we published the financial results. In the next few minutes, I'll try to briefly summarize the main highlights of our results. Net profit amounted to 1,857 million shekels. Very strong results, a 21% increase in net profit compared to last year. There are three factors behind the increase in profit. The first is a growth in revenue, an increase of 113 million shekels, which resulted from those price increases in contract renewals and the exercising of options, which were driven by the index. All our revenues are linked to the index, and there was also the full impact of assets that were occupied this year and last year, which this year were fully reflected. That's the first reason. The second reason is a larger asset revaluation compared to previous years. We'll touch on that in a moment. I'll elaborate a bit more. And the third reason is a decrease in financing expenses, a reduction of 108 million shekels in financing costs, which was mainly due to a lower index. This year, the index was 2.4%, while last year it was 3.4%. Many of our liabilities are linked to the index, so there was a reduction in financing expenses. Bottom line, 1.857 million shekels in net profit. The owner's equity also increased by 7%. 1,614 million shekels. The increase is due both to the real rise in rental fees, as well as the index I mentioned earlier, and to properties that were occupied this year or that were occupied during last year and generated a full year's yield this year. For example, Landmark A, which this year made its full impact on the financial statements. Our FFO, according to management's approach, stands at 1,234 million shekels, an increase of 6%. I'll elaborate on it in a few words in a moment. Ophir already presented the sales figures, so there's no need to go over them again. Cash flow from operating activities is very strong, with a cash flow of 1,214 million shekels from operating activities, excluding the residential segment. Note that in the residential segment, during the stage of land acquisition and inventory construction, the cash flow is actually negative by nature. It's rational and logical. You buy land, and that's considered negative cash flow from operating activities. If we isolate the contribution from income-generating assets, it's 1,214 million shekels, a 6% increase, which is very similar to the FFO. Occupancy rates are very high and have even increased slightly compared to last year, 99% in malls, 97% in offices. I mentioned that I would refer to investment real estate, 27.6 billion shekels, an increase of 1.9 billion shekels compared to last year. There are two elements to this growth. The first is investments, 600 million shekels in investments. This year, we also invested in Landberg, mainly Landberg B, Nof Hagalil, Yavne, the third floor in Ramat Aviv, the Kiryat Ono Mall, and other additional investments totaling 600 million shekels. The second element, the revaluations, amounted to 1,370 million shekels. The revaluations are based on the expected NOI, the representative NOI, which you saw earlier for the various properties, showing an increase compared to the NOI in previous years. It is important to note that there is almost no change in the capitalization rate. Our weighted capitalization rate stands at 6.84%, which is very similar to previous years. Our LTV, our leverage ratio, if we look at Aviv Meliesron as an investment, has decreased and now stands at 40.4%. The main reason for this decrease is, of course, the strong cash flow from operations that I presented earlier. When we look specifically, it's not possible to assess residential activity in terms of LTV ratio. When looking specifically, the correct approach is to consider the debt-to-cap ratio, debt-to-debt plus equity. This ratio is inherently higher than the LTV ratio. It stands at 50.3%. Here, too, there is a decrease, again as a result of the strong cash flow from operations. It was almost 52% last year and about 50% this year. The weighted average cost of debt is 2.48% linked to the index. I mentioned the FFO earlier, so I'll elaborate a bit now. The FFO grew by 6%, reaching 1.234 million shekels. The increase is mainly due to the growth in NOI. This growth is based on improvements in the operational parameters themselves. In the fourth quarter, the FFO was 321 million shekels. This means the annual FFO run rate is 1,284 million shekels. Again, 1,284. This year, the sum of all quarters is 1,234 million, so we can also see the improvement. It's a nice improvement throughout the year. Along with the publication of the reports, we have officially announced a dividend of 90 million shekels, which is about 1.9 shekels per share. This joins 3 previous distributions, so for the year 2025, we are distributing a total of 360 million shekels, almost 7.6 shekels per share. Alongside our investments, we see that the net debt balance has hardly increased. We started with 11.5 billion shekels in net debt. A strong operating cash flow of 1.2 billion shekels naturally reduces the net debt. But on the other hand, the indexation differences on the linked debt, the significant investments we are making, and the dividend that was paid all have an impact. And the transfer to Aviv Ben Nisson for the purpose of land acquisitions, mainly the purchase of the land in Sededov, on the other hand, increased the net debt. At the end of the year, it stood at 1,650 million shekels, which is very similar to the net debt balance at the beginning of the year. At the same time, we are also constantly ensuring debt servicing for the coming years. During the coming year, we need to service debt to repay debt in the amount of 2 billion shekels. We make sure to keep the treasury well-oiled with significant additional liquidity so as not to be dependent on changing market conditions in the short term. As of today, we have liquid assets totaling 1,600 million shekels plus unused credit lines of 500 million shekels. So again, we are not dependent on short-term market issues, even though the market is currently in excellent condition with low spreads. So of course, we can turn to the market for repayments if needed. We hold a substantial and significant volume of unencumbered assets totaling 12.2 billion shekels. In this context, it's worth mentioning that in April, in just a matter of a few short weeks, we will conclude the operation of Series Y bonds. Series Y bonds benefit from a first lien on the Overdet Mall, Ofer Petah Tikva, and this mall will be released from the lien and will join the pool of unencumbered assets. Currently, S&P Malot is actively reviewing our financial situation, and just a few weeks ago, they officially reaffirmed our high rating of AA with a very stable outlook for the future. I will give the floor back to Ophir, so thank you very much to everyone and good news. Thank you.
Fine. Let's talk a little about balance and summarize the future. Balance is also part of the future. So first of all, in terms of how we see the forward potential of the projects we have today, those currently under construction and in planning, these are the projects I detailed earlier. To sum up for a moment, these are projects, as I mentioned, with strong demand. They are not speculative projects. Some of them, as I explained, already have signed contracts, and some are located in fantastic locations, which also contributes to their value. Furthermore, when it comes to the mall and the expansion of malls like Horban, Ma'ale Adumim, and so on, these are small additions, but very significant for the mall. Every few thousand square meters that are added makes us happy. It only increases the mix and the appeal to come and visit the mall, to find everything you want and need there, whether it's a neighborhood mall or a city mall, and certainly in the large regional malls. So we anticipate that the current balance of what is happening will yield us an additional approximately 230 to 250 million shekels to the NOI. As I said, a strong NOI, and there are more upcoming projects, but they are scheduled for much later periods. So they do not currently appear in the NOI addition, nor in the addition of thousands of square meters. If we take a moment to look at the breakdown, all of this is the company's risk diversification. We used to be about 70% malls, 25% in offices. The diversification we've achieved with Aviv, even though we're growing, and growing very nicely, as you've seen both in malls and in offices, the overall volume has really increased, but the weightings have changed and will continue to change. Currently, the weightings are a little less than 60% in malls. The offices have remained the same, and Aviv, in previous moments, it was 11%. Today, it's already 12%. And as we move forward with the projects, as you saw, there are quite a lot of projects. This percentage will increase, and our risk diversification will actually fulfill what we aspired to achieve about 3 years ago. And if we look ahead, at how this will look in terms of NOI and the shekel, and it's worth talking about the FFO. Today we are at an NOI of 1.6, almost 1.7 billion shekels in NOI, so there will be growth here. We are seeing some very impressive and steady growth of these are deals that we feel very, very confident and very, very good about. We anticipate that we will very soon reach 2 billion shekels in OI, and that's without taking into account that we discreetly implemented increases to the rent prices. We haven't added here those 8% on average, and so on. We haven't even begun to include various other factors that are currently, let's call it, in the process of being finalized, like the Gold Mall, where we hope that by the end of the month we'll have an answer from the regulator and we'll know whether we're in or not. We're waiting, there isn't much time left, but by the end of the month we should already know. So this doesn't include new things, doesn't include the rent increase, doesn't include science, doesn't include anything at all. This is a picture of what the existing projects are and where they will take us. So they will bring us to about 2 billion shekels, and I hope we'll be above that as a result of what I mentioned earlier and new things that will be added. Regarding the FFO, today we are ending with an FFO of 1.3 billion shekels on an annualized basis, but our current run rate is already at 1.4, and we will reach 1.6 billion shekels. This growth comes from the same things we discussed earlier. We haven't taken into account here any assumptions about an interest rate decrease. Of course, if there is a decrease in interest rates, it will affect the financing and will increase our FFO. We haven't taken that into account. If there is a decrease in interest rates, it will be in addition to what we see here. I don't want to gamble on how much it will be, when it will happen, or at what pace. This is the current situation, according to the data we have today, and the current interest rate. The same points I mentioned regarding the NOI are, of course, also relevant in the opposite direction. Now, since everything I showed earlier concerns assets that are easy to analyze based on the NOI, and we've been tracking them for many years, they don't have the impact of residential properties. So what we did was say, wait a minute, what will be the average for residential properties in about 3 or 4 years, and what operating profit will that bring us to? Which means trying to translate this into operating profit, NOI, net operating income. And we did the calculation taking into account what the operating profit for Aviv will be during that period in 3 years. Of course, we try to approach this conservatively because with residential properties, sales, as we discussed earlier, are much harder to predict. So we see that our NOI or operating profit is no longer 2 billion, it's already almost 2.5 billion, okay? And why am I translating it this way? Because if we had invested in Aviv, instead of Aviv, and we had invested in another mall, then you would see another 400 million here. We didn't invest in that, we invested in other things. Their accounting language is a bit different. We tried to translate the accounting language, that's why you see it's kind of boxed in. But I think it's important because in the end, we're talking about a company that will bring in an operating profit of about 1.5 billion shekels. Compared to today, when we are at 1.6 billion shekels, it's not much longer. And you already know the projects, both in Maliesron, in the malls, in the offices, and in the residential sector. You already know the projects. So we are very, let's say, these are some of our biggest aspirations, and we hope to meet the benchmark we've set for ourselves. That's it. I'm glad we managed to conduct this entire discussion without any alarms and without having to go down to the shelter. And I'm happy that you're with us. We will continue to report and continue to provide you with the data. And I hope this war will end soon. And as long as it doesn't end, the wartime routine we've gotten used to will be more of a routine that's closer to normal life than to war. We've talked about this enough, and let's just hope it continues this way. Thank you very much, everyone. And if there are any questions, then
Now we will move on to the Q&A session. To send a question, please use the chat button located at the bottom of your screen. Before your question, please write your full name and your company's name. Yes?
what exactly are we supposed to be writing here?
The first question is whether there is a concern that NVIDIA will leave the old property in Yokneam once the new campus in Taiwan is completed.
That is an excellent and very important question to ask. Major global companies like Nvidia, Google, Waze, and Facebook are all tenants of ours who could technically choose to leave, but it is worth noting that they currently maintain fairly long lease periods of 5 or 10 years, which also include a specific exit option right in the middle of the term. For example, with Nvidia, it's 10 years, and there's an option along the way after 5 years, and it's the same with all our major and valued tenants. We are a development company. That's our advantage, but it's also the risks we take. Nvidia has been with us for a very, very, very long time at Ofer Yokneam Park, and they receive excellent service from us. I really hope it continues that way. They say no, meaning they are recruiting and recruiting and recruiting, and their recruitment plan is truly impressive. Not only are they planning right now, we understand what their plans are. They say, the sooner the building is finished, the better. We want to occupy the building. In Tivan, and when they have the space shift they are planning, it will take many more years. I imagine it's a decade from now. So until a decade from now, a lot will have changed in the country. They say they need both. Next.
Time for questions is up. And now I give the floor back to the Honorable Mr. Sarid, please.
Thank you very much for joining us, and we'll see you next quarter.
This concludes Meliesron Leninad's investor call for the fourth quarter of 2025. Thank you for your participation and have a pleasant day.